In doing paper F9, a very important part of the paper is DCF techniques, where we are looking at shareholders' wealth. Shareholders' wealth is equal to PV of future cash flows. And in arriving at this PV of future cash flow, we must understand that cash flow has got specific rules when you come to this paper. And we are going to go through the specific rules today. And any cash flow you capture must be a relevant cash flow and not any inflow, outflow, as you can see. And it must be specifically related to a particular project. That's what you must always remember when you do relevant cash flow. In applying the principle, we are looking at a few important rules as follows. Firstly, fixed asset investment used in the project is a cash outflow. Scrap values on that particular asset are treated as cash inflows. Any existing fixed asset used on the project is a non-cash because you already bought it long ago. Second principle, we are looking at fixed overhead. Fixed overheads is always treated as non-cash if it is allocated or apportioned. However, if the fixed overhead is specifically on a particular project, then it is a relevant cash outflow for that particular project. Besides that, cost savings is also a cash inflow. Obviously, any cost saved will help to maximize shareholder wealth, resulting in cash inflow. When you sell products generated from that project, products will generate contribution. Contribution is obtained by taking your sales less your variable cost. Such positive contribution will have the impact of increasing shareholder wealth. Therefore, it is a cash inflow. And a very difficult concept which is always hard to determine in examinations is opportunity cost. Opportunity cost is always treated as a cash outflow. What do you mean by opportunity cost is a cash outflow? A typical example will be material in stock. Material in stock is material already bought previously, but you're going to use it on this project. Should we take it as a relevant cost or should we take it as a sunk cost? A relevant cost is cash outflow. A sunk cost is non-cash. To determine the answer, we ask three questions. First question is the material regularly used? Your answer could be yes or no. If your answer is yes, then there is a relevant cost called current cost. If your answer is no, then you ask the second question. Has the material got any alternative use? Again, your answer could be a yes or could be a no. If your answer is a yes, then you have to use a value in use. If your answer is a no, then there's the third and last question that you must ask. And the third question is, can the material be scrapped? Again, your answer could be a yes or could be a no. If your answer is a yes, then you can use a scrap value as the opportunity cost. If your answer is still a no, then material becomes a sunk cost. So you only decide a sunk cost after looking at these three questions in front of you every time. However, if you need to pay money to throw away this material, then by going into the project, you save that money that you need to pay to throw away. That is a cost savings which is treated as a cash inflow. And this is the logic behind sunk cost, please. Then we come to working capital. Working capital in the project is always a cash outflow in the year of injection. At the end of the project, all working capital have to be released. When they are released, it is a cash inflow. Tax on the project is always decided by looking at the operating cash flow. If your operating cash flow is positive, then the tax becomes a cash outflow. But if your operating cash flow is a negative, tax becomes a cash inflow. Also, you have WDA or writing down allowance tax claim. Tax claims are always a cash inflow in the subject, please. And last two principles are critical. Investments that you make, you take a loan or you use equity. When you take a loan, you pay interest. Yes, interest you pay cash, but this amount of interest is treated as non-cash. Equity, you pay dividend. Dividend is also treated as non-cash. Why are these two non-cash? Because these two elements are already included into the company's cost of capital. And since cost of capital is used to discount the project, these are known as non-cash items.